So Fatima is a sole trader. Fatima is a sole trader. She prepares her financial statement to the end of March each year. At 31 March 2022, Fatima's ledger account balances included the following. So these are her ledger accounts. We have revenue. So I'm just going to say the items and where they have to go to. Revenue. Okay, let's just go straight up. So we are told to prepare we are told to prepare the income statement for the year ended 31 March 2022. So we have the information, we have the items. Revenue. So revenue, we start with revenue, which is 79,400. We have sales revenue. You less sales revenue from revenue. Yeah. So yeah, it's the same as sales revenue. It's still revenue return or sales returns is the same. So you less it from 79,400. That gives us 75,430. Yes. Then now we less cost of sales. Our cost of sales include the opening inventory, which is inventory at 1 April 2021, 3,000. Then we have purchases. We had purchases to it, which is 36,500. That gives us 39,500. Yes. Then we have Fatima. Yeah, they said Fatima took goods for our own use from the business during the year ended. So you less goods for own use, which is drawings. We call it goods for own use. You less it from the closing from the purchases. So as soon as you less that, then we have closing inventory, 31 March 2022. You also less that from you less it again. Yes. So that will give you the total cost of sales. So our cost of sales, the total of cost of sales is 35,080. So 35,080 minus 75,430. That gives us our gross profit, which is 40,350. Yes, you want to talk about discount receipt? Yeah, we had it up with the gross profit. So for now, we are done with revenue, we're done with sales returns, we're done with purchases, we're done with opening inventory, we're done with closing inventory, we're done with goods for own use. So we have our gross profit. So with our gross profit, we have discount received. So your gross profit is 35,080. You add discount received to it, 1,095. So that gives us 41,445. Done. Yes. Now we less expenses. The first expenses we have here is rent and rates. For rent and rates, we have 9,000. Yeah, sure. For rent and rates, we have 9,000. So that's not going to be the only rent and rates. We have information here. They said rent includes a payment of $1,500 for the 3 months from March to May. So from March, we have April and May. So that means 2 months out of the 3 will be left. So we have, the value is 1,500. So that means 1,000 is what we add up to our rents and rates. Yeah, we left it here. Sorry, we had them together. That's 2 over 3%. 2 over 3 over 1,005. It gives us 1,000. Do you get it? We left it from the total cost because we're talking about March. Okay. So that's 9,000 minus 1,000. So that gives us 8,000. I think that is clear. Okay, that's the first rent and rate. Then we go to wages. For wages, we have 10,100. Well, there's another additional information for wages. They said there's another additional information for wages. Wages. Okay, accrued wages, which means that wages were owed by the business. So we add it to the real wages we have. So that's 10,100 plus 800. That's 10,900. It's part of our expenses. Yeah. So we are done with rent, we are done with wages. Now we have general expenses, which is 1,287. Nothing, there's no information about it. There's no additional information. We had it up. Then we have insurance. We don't have any additional information about it. We had it up. Then we go to depreciation on fixtures and equipment is to be, they said depreciation on fixtures and equipment is to be charged at 20% per annum using the reducing balance method. So because we have provision for depreciation, the value of fixtures and equipment is 80,000. And we have provision for depreciation for equipment, which is 39,040. So 80,000 minus 39,040 multiplied by 20% gives us how much? Gives us 8,192. So for depreciation on provision for depreciation will be 8,192. That is done. Then we have irrecoverable debts. The value of irrecoverable debts is said to be, they said an irrecoverable trade receivable of $200 is to be written off. So we have irrecoverable debts of $200 written. That's also an expenses there. Then we go to provision for doubtful debts. For provision for doubtful debts, we have information. Here they said 3% of trade receivables. So we have our trade receivables to be 6,400. So 6,400, yes.
Minus the 200.
6,400 minus the irrecoverable debts, which is 200, gives us 6,200. So 6,200 multiplied by the how many percent?
3%.
3%. It gives us $186. So 186 minus the provision for doubtful debts is what we use as our provision for doubtful debts, which is $30. Then that is all about that. Then you add all together, it gives us 30,409. So 30,409, you less it from the profit, which is gross profit, which is 41,445. So we have our net profits to be 11,036. Is it clear now?
Yes.
So now we have to prepare capital account. For the capital account, on the debit side of our capital account, we have drawings. Yes. And on the credit side of our capital account, we have our balance and we had profits to it.
Yes.
So for our drawings, we have the information for drawings in the capital account now. We have drawings, we have, hold on please. Drawings, we have cash drawings of 8,580. Yes. Then we have for own use, goods for own use. Goods for own use in the additional information.
Which is 1,000.
1,300. So 8,500, 8,580 plus 1,300 gives us our total drawings. So that is 9,880. That will be on the debit side. So on the credit side of our capital account, we have our balance brought down, which is the value of the capital at 1st of April 2021, 59,000. Then we need to add the profits to it. Profit is 11,036. So 11,036 plus 59,000 gives us 70,036. So 70,036 is what we take away from our drawings. That is what that will be our balance carried down. And to be our balance brought down for April, which is 60,150. So the value of our capital account is 60,156. Is it clear now?
Yes.